Hello and welcome to Chapter 3B. So, we talked about some of the standard setting, FASB, SEC, International Accounting Standards Boards. And so, we went through some of the assumptions. And so, now we're going to go through and get to the meat of things. The how do we record the information? So, um, utilizing the accounting equation to analyze transactions. So the accounting equation again is assets equal liabilities plus equity. Every financial transaction that happens affects the accounting equation, which means they affect the balance sheet. Now, the financial statements are set up such that, again, on the equity side, what eventually happens and what in reality is happening is when you have revenue that increases equity, and you have expenses that decreases equity. Now, equity is on the right side of the equation, so it has a normal negative balance. So that means that if you are going to increase equity, you need a negative number or a credit. If you're going to decrease equity, you need a positive number or a debit. So revenue is always a credit or a negative number in the accounting equation. The accounting system is determined by, again, the company. If you are a merchandiser, then you need an inventory account. You may need various inventory accounts, or you may need various expense accounts so that you can track how your inventory has been sold by group. Walmart may have several categories. They may have food, cosmetics, clothing, automotive, etc. And so they want to be able to track those types of things. Now, the accounting system basically, again, is we collect information and we put it into the accounting system and then we produce financial statements. And so there are various ways of getting that information. When you go to Home Depot or any store and you are self-checking out, you're actually part of the accounting process. What you're doing is you're scanning that barcode, and then that is telling the system, all right, deduct this product from inventory and move it to an expense, and then record the sale of this item and either cash or accounts receivable. But in this case, it's going to be cash because you're either paying cash or you're paying a credit card, and credit cards are assumed to be cash. So the type of accounting system you have and the accounts that you have are going to be dependent upon the type of company you are. If you're a service company, you're not going to have inventory. So factors that shape an accounting information system include the nature of the company's business, the types of transactions, size of the company, the volume of the data, and the information demands of management and others. If you are a one store and you sell pianos, you could probably get away with just doing an Excel spreadsheet or some type of QuickBooks or even just a ledger, which is, a bunch of pages and each page consists of an account. That's a little more difficult because then there's a lot of more manual process. But if you're Walmart, then you're going to need a robust computer system because you're going to need to record things automatically. So we put things into the accounting system either automatically via the self-checkout type, or we do what's called journal entries, and we upload information into the accounting system. So transactions are an economic event that require recording the financial statement. So again, monetary assumption, that means we're going to record this in dollars. So dollars or some type of financial transaction has to take place. Not all activities represent transactions. Economic events that require recording the financial statements are accounting transactions. So if you buy something, sell something, lend money, borrow money, sell stock, um, expense items, These are all financial transactions and they can be recorded because you know the dollar amount. Accounting transactions occur when assets, liabilities, or stockholder equity items change as a result of some economic event. So here's the basic accounting transactions decision process companies use to decide whether or not to record economic events. If you purchase a computer, well, if you purchase a computer, even if you don't pay today, that's an economic event and you have incurred a liability, which you will then have to pay in cash. Discuss guided trip options with potential customers. That has no financial impact, no dollar amount. Pay rent, yes. Pay rent now. You are exchanging dollars for the ability to utilize the space. Again, the accounting transaction also is a balance sheet, assets equal liabilities plus shareholder equity. Now, the accounting system is a double-sided type of system. When you record something in your checking account, all you're doing really is you're recording one side of the transaction, the cash side. So your checking account is an account, it is your cash account. And you record everything that happens during that month. So when you buy something, you deduct it. Again, this is an asset. It's on the left side of the equation, so it has a normal debit balance. When you add money to your checking account, you have a positive number. When you subtract money from your checking account, you have a negative number, and that's called a credit. So again, if an asset is increased, there must be a corresponding decrease in another asset. For instance, let's say you buy land with cash, increase in a specific liability, you buy land for a loan, or increase in stockholders' equity. Stockholder exchanges land, an asset, for shares in the company. Assets again equal liabilities plus shareholder equity. Retained earnings is under shareholder equity, as you've seen. So stockholders' equity again consists of common stock plus retained earnings. So retained earnings are increased by revenues, decreased by expenses, and decreased by dividends, because again, it represents the amount of profit that you're keeping in the business. Now, a revenue means that you are doing whatever business you're involved in. If you are Walmart, you have sold something. So when you sell groceries, that is revenue. If you're at Chick-fil-A, when you sell a chicken sandwich, that's revenue. If you're a plumbing company and you come and you fix something and they give you money for fixing that, or you bill them for that, that's revenue. So revenue again is you have done work in some way, either sold something. If you're in the construction business, you built something, you maybe built a house and you sold that, that's revenue. And the expenses are the cost involved in generating that revenue. So for Chick-fil-A, the cost would be the people, the salaries of the people that work there, the benefits of the people that work there. It would be the food cost. It would be the electricity. It would be gas, so utility expenses, insurance, taxes, etc. Those are expenses. Those are things you have to do to generate that income. And of course, dividends is just a return of an investment to a shareholder. So we are going to be looking at how each of the following transactions affects the balance sheet. All right. So the first one is that they've invested $10,000 in common stock. That is going to affect assets. So we are going to increase cash, a debit, by $10,000. And so now we have to have a credit of $10,000. And that is common stock. So assets equal liabilities plus owner's equity. So 10,000 equals 10,000. Now we're going to borrow $5,000 from Castle Bank, signing a 3-month, 12%, $5,000 note payable. So what have we done? We have exchanged cash or promised to pay this cash back. That's a liability. So we add the $5,000 to cash. So $5,000 asset is equal to liabilities plus owner's equity. So it doesn't affect owner's equity, but we have created a liability. So now we have $15,000 assets equal 5,000 liabilities plus 10,000 equity. We purchased equipment by paying $5,000. So this is a case where we have increased one asset but decreased another. And so we're going to pay $5,000 cash. So just like you would put a negative sign on when you're withdrawing cash from your checking account, same thing for a company. So again, we are just changing the composition of our assets. We did have $15,000 cash. Now we've got $10,000 cash plus $5,000 of equipment. We still have $15,000 of assets. This did not affect the liabilities or the shareholder equity. We received $1,200 cash in advance from R Knox. So this is a liability. That's an advance, and that means that we either have to do work or we have to give the client the money back. So that's a liability until we have satisfied that. So we have increased an asset and we have increased a liability for the same amount. We've received $10,000 cash from Copa Company for guide services performed. All right, so we've done work. We've earned revenue. So in exchange for us doing work, we are going to, again, if we do work, revenue increases shareholder equity because it increases retained earnings. So we have assets, cash that we've collected, no change in liabilities, but now we have a $10,000 increase in shareholder equity. A tabular analysis of transactions made by Mendez for the month of August is shown below. All right, so now you can see that we have assets of $39,150 are equal to liabilities of $61,150 plus owner's equity of $33,000. So assets equal liabilities plus owner's equity. And you can see we have $32,150 in cash and $7,000 in equipment. The company issues shares of stock to stockholders for $25,000 cash. Okay, so what is that going to impact? Well, that's going to impact cash, number one. So we're going to have a debit of cash, an increase of $25,000, and we sold stock. So we're going to affect common stock, which is under shareholder equity. Okay, on October 3rd, Sierra paid its office rent for the month of October in cash. This is an expense we owe for rent for October. And normally you expense things at the end of the month after you used it, but since it really doesn't matter inter-month, you're going to go ahead and expense it. So that's an expense, and that reduces retained earnings. So that means it reduces shareholder equity. And so cash is going to decrease by 900, and stockholders' equity is going to decrease by 900. Now this shows negative, but this is just showing you that it means it's decreased. But in reality, this would be a debit to asset and a credit to shareholder equity. On October 4th, we paid $600 for a 1-year insurance policy that will expire next September. So this is something that we are going to basically expense over the year. So every month, it's basically $50. So every month we're going to take this prepaid asset. So right now we have an asset, and if we decided to get rid of whatever we're insuring, we should get cash back. But every month we're going to use that up. And so it's going to be an asset, but every month we're going to use that up. So then we need to transfer that to expense every month. But for now, We're just swapping assets. You've got a prepaid insurance. Again, we're going to expense over the course of 12 months. And we've got a decrease in cash. We purchased an estimated 3 months of supplies on account. Same thing, a prepaid expense. So we have supplies, but we did this on account. So that, again, we've created a liability. We're going to have to pay the company at some point the $2,500. And so we have an increase in an asset and an increase in a liability. On October 9th, we hired 4 new employees to begin work on October 15th. No financial transaction at this point. There's no financial until we start paying them. October 20, Sierra paid a $500 dividend. And so we're going to, again, this is going to affect assets and equity. Retained earnings, again, is the amount of profit we keep in the business that we don't distribute to shareholders. We're distributing some of the profit to shareholders. So that means that we're going to have a decrease in an asset and a decrease in shareholder equity. Employees worked 2 weeks, earning $4,000 in salaries, and were paid. All right. So again, expense that decreases our net income, which decreases retained earnings, which decreases shareholder equity. And we've used cash, so we've got a decline in an asset, no impact on a liability, and a decline in shareholder equity. And so here are these transactions, and again, assets of $14,450 are equal to liabilities of 0 plus stockholders' equity. Stockholders' equity is the initial stock sale plus the initial service revenue. And then we subtract the expenses and the dividends, and that gives us $14,450. So here is a summary of the things that we have are going to happen here. So, all right. The illustration demonstrates 3 important points. Each transaction is analyzed in terms of its effect on assets, liabilities, and stockholders' equity. If you're looking at a transaction, I always say, okay, is this a cash transaction? If it is, did we add cash? And if so, I know I'm going to debit cash for that amount. And that means I'm going to credit another account. The 2 sides of the equation must always be equal. So for your project, if they're not equal, then something's wrong. The cause of each change in revenues or expenses must be indicated. And so what we have here really, this is really your accounting system. And what we have would be a trial balance, and a trial balance just shows every account and the balance. So it's going to show all of a cash account of $15,200, a supplies account of $2,500, a prepaid insurance account of $600, equipment of $5,000, so on and so on. Anything on this side is going to be listed as a negative number, so that the positives plus the negatives should equal 0. Our goal is we're going to prepare for financial statements, and we have to do it in this order. We have to first do the income statement, then we do the retained earnings statement, because the retained earnings is net income plus beginning retained earnings plus net income minus dividends. And so that is the retained earnings statement. And that figure goes to the balance sheet. And then we just list everything that was on that trial balance. Okay. So we have service revenue of $10,000 again. So we did work and we earned $10,000. We might not have gotten paid $10,000, but we had hoped to. And then we have expenses that were necessary to earn this revenue. And so total expenses, so revenues minus total expenses is equal to net income. So this is the first statement. Secondly, we do the retained earnings. We just started, so we have no beginning retained earnings. We're adding the net income from above. We're subtracting the $500 in dividends. And we are keeping $4,600 of our profit in the business, and that's going to go to the balance sheet. And then we just list all the every other items. So total assets is equal to liabilities plus equity. And so 23,300 equals 23,300. And basically that does the same thing. So you're going to do a project, and we'll talk about the project later, but you'll get to know this, and you're going to be acting as if you were an accountant for the first month of operations for a new landscaping company. But I'm going to give you all of the details, so if you follow the directions, it should be fairly simple.